What's up guys, this is Muhab, and in this video I'll show you 5 growth stocks I am buying in the 2020 market crash that happened as a result of the thing that is going on right now that I cannot name or I'll get demonetized. This video is mainly for the people who their income was not affected from the current situation and have a 3 to 6 month worth of their expenses as an emergency fund and still have cash lying around to invest. If you can tick all of these criteria, then this is one in a lifetime opportunity to invest in great companies at cheap prices. However, if you don't have an emergency fund or you just got laid off your job, cash is king. Give yourself some time to sort out your finances and find a job before investing. The stocks will start from the most risky growth stocks to the 2 stocks that represent 50% of my portfolio, so stay tuned until the end. But as always, before we start, don't forget to smash the like button and subscribe for more videos, and let's roll the intro. Beyond Meat is a plant-based meat substitute provider. It sells a wide range of products including vegan beef and pork. The company IPO'd back in May with a listing price of $66 at the New York Stock Exchange, and in just 2 months the stock reached just under $235. But then it fell hugely after people realized how overvalued the stock was at that price. It had a similar story to Bitcoin back in 2018. However, now the stock is just under $60, which is below its listing price. The stock got hit huge from the current problem that is happening in the markets. And to be honest, the stock never really caught my eye before, as I always thought it's fairly valued at best. However, after it fell under $60, I've been having an eye on it for some time. Alright, let's talk numbers. First of all, many analysts believe that the stock is fairly valued at $100 to $130. Even though the stock is currently not profitable, the stock growth is insane. In the fourth quarter of 2019, the revenue surged 212% year over year to $98.5 million, bringing full year revenue to $297.9 million. Beyond Meat's guidance for 2020 calls for revenue to grow to a range of $490 million to $510 million, good for 64% to 71% annual growth. In terms of profits, the company said profits will be muted for 2020 because the company is investing in its growth to capture the opportunities it sees, specifically on a global basis. In an interview with Yahoo Finance, CEO Ethan Brown said that despite the current situation outbreak, Beyond Meat fully intends to enter China later this year. In addition to all of that, the company made deals with restaurants and cafes like Dunkin' Donuts and Del Taco. They also got their eyes on partnerships with KFC and McDonald's. However, these partnerships may be delayed due to the current situation out there. The current situation may also lead people to eat less meat and move more towards vegetarian or vegan food. So long term, the company may actually benefit from what's happening right now. Now, one of the main things that I look at when a company is in growth mode is how much cash it got. Beyond Meat got $276 million in cash and only $31 million in debt, which is extremely great. That means it can still fund its expansion and growth without adding more debt to its financial sheets. With all that good news, why is this my first stock and my most risky stock in my opinion? It's because usually the meat industry has very low profit margins, and in addition to that, Beyond Meat is still more expensive than traditional meat. So if the growth didn't pay well, which is quite unlikely to be honest, but if that happened, then the stock will be considered overvalued. Since not only it's not profitable, but also running at a price to book ratio of 10, when companies like Kellogg's, Pepsi and Coca-Cola are running around ratio from 2 to 5. However, if the forecasted growth was right, which is a minimum growth of revenue from 35 to 40% a year, and managed to get profitable by the year 2021, then this stock should be valued around $150 to $300 by the year 2020. Note that this is just my forecast and I could be wrong. It's extremely hard to predict the stock price of companies that have great growth but barely any profits, like this company and Tesla for example. Alphabet or Google? I mean, do I really need to introduce you to the company? But in case you were living in a cave for the past few decades, Alphabet is the company that owns Google, YouTube, Android, Google Cloud, Gmail, and many more products. Alphabet is currently trading at a forward PE ratio of 20 and a PEG ratio of 1.24. That is really great. The stock is currently just under $1,100 and many analysts believe this stock should be at least $1,400 and others went as high as $1,800. The company's revenue growth is around 15 to 20% a year, which is extraordinary for a company that size. And advertising is not going to slow down in the long term, and it's going to move more from traditional TV ads to digital ads. In addition to that, Google Cloud and Google Play Store, hardware and other products and services is growing rapidly too. All of that is in addition to an extremely good gross profit margin of more than 50%. I always wanted to invest in Google, however, I felt that I'm paying premium for it at a $1,500. But since now it's less than $1,100, I think it's a buy in my opinion. Next, we got Visa's younger brother, Mastercard. Mastercard had fallen so hard in the past few days, it fell 41% top to bottom. The stock was at $344 and it went back to almost $200. Mastercard currently has a PE ratio of 29, which is quite high when you compare it to other stocks. However, last time Mastercard had that low a PE ratio was in 2017. After that, it always had a PE ratio of 39 and above. Its brother Visa has a slightly low PE ratio and always did. However, Mastercard's growth is slightly higher than Visa at a 15% compared to 13%. Even though both Visa and Mastercard will both win from the war against cash, Mastercard was on this list due to the slight edge it got on growth and its smaller market cap, which gives it greater room to grow. Personally, I am an investor in both companies. However, when Mastercard price dropped close to 200 and its PE ratio became lower than Visa, I focused more on Mastercard. Now we got to the stock that makes 25% of my stock portfolio, Alibaba. This stock, in my opinion, is like stealing money if it's below $200 a share, and it's currently at $187. The only thing that is preventing me to buy more is that I don't want my position in it to be extremely large. The company has price to sales ratio of less than 10, PE ratio of 20, a PEG ratio of 1. The company is growing at a 35 to 50% rate and many consider it to be a recession-proof stock, which is really good to buy in April despite the current situation. It is the most important Chinese commerce, accounting for 66% of all revenue in fiscal year 2019. In addition to retail, the company cloud service, Alibaba Cloud, is growing at least 50% in revenue, which is insanely good. The company currently has 693 million active annual Chinese customers and it's targeting 1 billion customers by 2024. And that represents 44% customer growth in the next 5 years in China alone. The company is also planning to expand globally, mainly in Asia. Alibaba is also involved in payments processing with Alipay, marketing services, and digital media and innovation initiatives, which will all boost the revenue for the company long term. The company also has twice as much cash as it have in debt, with cash over 30 billion US dollars. That means not only it can fund for its innovative projects, but it can also withstand any short-term drop in the market. Also, it's worth mentioning that the situation in China is getting much better now compared to other countries around the world, which may give it an edge to Alibaba compared to Amazon, for example. I believe at this growth, the company can reach $1 trillion market cap within the next 3 to 5 years, which means a double in its market cap. And that could lead the stock price to at least double, since it's currently undervalued in my opinion. Finally, one of the most undervalued stocks in my opinion, Facebook. Facebook is currently trading at $154 and a PE ratio of 24. The company has a PEG ratio of 0.77. Facebook, the company that is dominating the digital advertising industry with Google and growing at 20 to 25%, has a PEG ratio of 0.77. It is usually a thumb rule that a company with a PEG ratio of less than 1 is undervalued. However, it's really hard to find an undervalued company with a market cap of $500 billion. Not only that, but the company has enough cash not only to fund all of its future projects and buy whatever company it wants, but also it's now funding small businesses so that they can survive what is happening right now. In my opinion, This stock is like stealing money from the bank if it's trading anywhere close to $200, and it's currently trading at $154. Facebook is currently the largest position out of all of my stock portfolio, making more than 25% of my stock portfolio. I made a whole video of why I think Facebook is a strong buy, and I made that video when the stock was well over $200. If you want to know more details about why I think Facebook is a strong buy, I highly encourage you to watch that video. I'll leave the link for the video in the description below and a card at the end of the video. Alright guys, that's the end of the video. I hope you've enjoyed it. If you did, please don't forget to smash the like button, comment something for the YouTube algorithm, and subscribe too. Thank you for watching. This is Mohab and I am signing out.